Hey there, Joe, your mortgage pro. Just wanted to give you a quick update in case you missed the last one I had. With regards to the Fed's cutting rate, we initially posted something about that when it happened on September 18th. The Fed cut 50 basis points, which, as you may know, we've seen 30-year fixed mortgages rates rise, and they've rose, meaningfully as far as the amount in increase. And we get a lot of questions about, how you may be wondering how this can be. Well, let me tell you, the Fed is reducing the Fed funds rate, which is not necessarily mortgage rates or even long-term rates. The Fed funds rate is a very short-term interest rate. Literally, it's a rate that's only good overnight. This is a rate that banks use as the rate that they lend money to one another. But it is a building block for all interest rates. So don't get me wrong on that. But when the Fed changes the Fed funds rate, it almost immediately impacts things like money market accounts, credit cards, car loans, home equity lines of credit, et cetera, et cetera, et cetera. It's all those interest rates that are, what we call short-term rates. So again, unlike long-term rates such as mortgage rates, those are impacted more indirectly. An example of this that happens is the Fed cuts the rates and investors' return on the money market funds decrease. Yeah. So it's anticipated that the Fed will continue to lower the rates, which in turn will continue to reduce the return on those money markets, or investors, are going to want to preserve those returns by selling the money market accounts and buying longer duration bonds like 10-year treasury, or as more 10-year treasuries are purchased, their price tends to improve, which in turn lowers the yield. That's what makes mortgage rates typically fall in the direction of the 10-year treasuries, not the short-term interest rates. Recently, in anticipation of a well-telegraphed rate cut, like we mentioned to a lot of you, we told you to get in before that day, because on that day, rates actually increased, right? But again, the 10-year treasury and the mortgage rates had actually declined leading up to that point, as we mentioned. Therefore, the financial markets are already priced it in by cutting their treasuries in advance of the Fed announcement. So what does that all mean? Well, after the Fed's cut, surprisingly, a strong job report and a more stubborn inflation data that were released, this has created the spike in mortgage rates, which is what we've seen September 18th. It's quite possible, though, that the Fed will continue to reduce rates and eventually see that filter into mortgage rates. Or we could have a war or something else that seems to be one of the things that will make mortgage rates decline. But until then, just wanted to give you a quick update on why these things happen. We look forward to helping you. Again, Joe, your mortgage pro out. Have a great Monday.